Okay, next question comes in by email. My question is about factor investing and tilting towards small cap value in particular. I understand that historically small value has done better than the total market, but it has struggled more recently. My question is, isn't it possible that small value stocks were priced too low historically, then studies and articles came out about how great of a buy they were, and now their pricing is corrected such that their long-term returns are consistent with the rest of the market? Yes, that is possible. It is one possible way to interpret the data. The market generally prices in all the public knowledge that's out there, so once it became widely known that small value historically outperformed, wouldn't you expect the increased investment in that area to close that price gap and lead to performance consistent with the rest of the market? Or put another way, I have a hard time believing that one category of stock will just continue to outperform everything else over a long time because everyone would buy it and the price would go up. I know you tilt towards small cap value, so I'd love to hear your response to this. And if the answer is there's more risk, so more reward, then please clarify why small growth stocks, which are more risky, wouldn't have even greater returns. Thank you. Okay, so yes, it's possible. It's possible that that phenomenon is just a result of data mining. Our data in finance is very limited. You got about 100 years of good data and another 50 or 100 years of okay data, and that's it. And you probably only got it in a handful of countries. And most of those countries, besides the US, you've only got it going back 30, 40, 50 years. And so the data is really limited. And it's possible that you're just finding, a fluctuance in the data that is not actually a true thing. This isn't physics, right? You can't run the experiment 1,000 times and really be confident in your answers. It's investing, and it's a bit of a social science in that respect. So that being said, those who really believe in and know about small in value, this factor investing, they believe that it is probably a risk story, that small value stocks are riskier than large growth stocks. The smaller the company, the fewer products they have, the less cash they have, the less ability they have to weather a big economic storm. A value company, of course, is also generally in a more precarious position than a growth company. And so in that respect, it's also a little bit more risky. So the idea is that you are paid more, your return is higher in the very long run for investing in small value stocks because you're taking on more risk. Part of the story may also be what we call a behavioral story. Basically, people avoid these stocks. They like the sexy companies they've heard of. They like the FANG stocks, your Apples and your Facebook and your Netflix and your Zoom kind of stocks, because you've heard of them and you know they're growing rapidly and they're in the headlines. And so because of that, people are more likely to invest in those stocks and stay away from small value stocks. And I don't see any reason why that would change either. I mean, the risk story is not going to change. The behavioral story is not going to change. There have been long periods of time, of course, where small value did not pay off, where it was outperformed by the overall market and other segments of the market. And so you have to expect that going forward, that even if over the 30 to 60 years that you invest, even if small value wins over that time period, you should probably expect a 15, 20-year time period somewhere in there where they underperform. So it's really a lifelong commitment if you're going to invest your portfolio and tilt it toward small value stocks. So that brings us to small growth. What is the deal with small growth? Well, for a long time, people talked about small growth being a black hole, right? That it suffers from a lottery effect where people are essentially taking a gamble on these stocks in hope that they're finding the next Facebook. And so because of that, they're willing to accept lower returns, just like people buy lottery tickets, knowing that they're probably losing their entire investment, but maybe, just maybe, they're going to strike it rich. And so that is why they have postulated that there has been this, poor performance of small growth in the long run. Of course, in the last 10 years, the performance hasn't been that bad at all. And so maybe that was just a factor that came from data mining and isn't real either. But only time will tell. In some ways, you only get one ride around on this roller coaster, and you gotta make your bets and take your chances. And so that's what you're doing with small value investing. You might believe that over your time horizon, it's going to pay off, but don't tilt your portfolio more than you believe. Otherwise, you'll panic in a moment like this and end up selling low just before small value starts doing really great. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.